And welcome back to Stock Scope. Stop listening to the noise about an AI bubble. Microsoft just released the most important earnings report of the decade. They are not just winning, they are leaving the entire market in the dust. While competitors promise the future, Microsoft just cashed in on it. If you hold any tech stocks, you need to see exactly what just happened. Let's get started.
But wait, if the numbers are so good, why is the stock down 7%? Here is the answer, and it is buried in the cash flow statement. Look at the Capex line. Microsoft spent $29.9 billion on infrastructure in just 90 days. That is practically double what they spent last year. They are burning cash at a historic rate to build these AI data centers. Investors are terrified that this capital intensity is eating into margins before the revenue creates a return. Wall Street is asking, is this sustainable, or is it a money pit? We start with the wow number of the quarter. Look at that net income growth. Microsoft delivered a staggering 60% increase in GAAP profits, hitting $38.5 billion. Earnings per share came in at $5.16. This is the definition of operating leverage. While revenue grew by 17%, profits grew more than 3 times faster. This proves that Microsoft isn't just growing. It is becoming significantly more efficient as it scales. This slide represents a historic milestone. For the first time in history, Microsoft Cloud revenue has surpassed $50 billion in a single quarter. To put that in context, this segment alone is now running at an annualized rate of over $200 billion. This business unit is now larger than the GDP of many nations. If anyone had doubts about the demand for cloud computing or AI infrastructure, this chart ends the debate. The demand is not slowing down. It is accelerating. Let's look at the top and bottom lines together. Total revenue hit $81.3 billion, up 17%. But look at the operating income, $38.3 billion, up 21%. This demonstrates execution excellence. Despite inflation and rising energy costs, Microsoft is squeezing more profit out of every dollar of revenue than they did last year. They are managing costs aggressively while funding the largest infrastructure build-out in history. Investors need to understand this divergence. You see GAAP growth at 60%, but non-GAAP growth at 23%. Why the gap? It is largely due to the OpenAI investment impact. The revaluation of their stake in OpenAI creates noise in the accounting. Do not let this distract you. We view this as strategic volatility. Microsoft is willing to accept short-term accounting swings to secure long-term dominance in the AI ecosystem. Here is the engine room, the intelligent cloud segment. Revenue came in at $32.9 billion. This segment includes Azure, which is capturing market share faster than its competitors. The primary driver here is AI training and inference. Companies are not just storing data anymore. They are using Azure to build their own AI models. Microsoft has effectively positioned itself as the world's computer. Moving to the productivity segment, this is Office, LinkedIn, and Dynamics. Revenue hit $34.1 billion. The operating income here is massive at $20.6 billion. This is the cash cow. Legacy software margins are funding the future. But crucially, we are seeing the Copilot effect. AI features are being integrated into Word, Excel, and Teams, driving the average revenue per user higher. Microsoft 365 is proving to be under... CEO Satya Nadella made a critical statement in the call. We are only at the beginning phases of AI diffusion. We are moving from building the stack to pushing the frontier of usage. We are seeing AI adoption spread beyond tech into healthcare, energy, finance, and retail. This expands the total addressable market. It is no longer just about selling chips. It is about rewiring the global economy. Now, we must address the elephant in the room, capital intensity. Microsoft is spending historic amounts of money on data centers and GPUs. This is investing for dominance, but it comes with a risk. If demand slows down, this massive infrastructure build-out creates a depreciation drag. They are building for a boom that must continue. This is the single biggest financial risk to the stock right now. However, the company has an incredible safety net. They ended the quarter with $24.3 billion in cash and equivalents. This bulletproof balance sheet allows them to absorb these aggressive capital expenditures without any financial strain. Unlike smaller competitors, Microsoft can afford to make mistakes. They can outspend and outlast almost anyone in the industry. Let's be objective and look at the bear case. First, valuation. The stock is priced for perfection. Any deceleration triggers a... Second, the Capex trap. Are they overbuilding? And third, volatility. As we saw with the GAP numbers, the company's earnings are increasingly tied to the private valuation of OP. If the AI bubble bursts in the private market, Microsoft's books will take a hit. But the bull case is powerful. First, real monetization. That $50 billion cloud number proves this isn't hype. It is a real business. Second, margin expansion. Growing profits by 60% while spending billions on chips is an engineering miracle. And finally, the sticky ecosystem. Companies cannot simply turn off Microsoft. It is ingrained in the workflow of the entire Fortune 500. This provides a floor for the stock that other high-growth tech names don't have. So, is the stock too expensive? When we look at the PEG ratio, price to earnings relative to growth, the premium looks defensible. You are paying up for stability plus growth, compared to peers who have high growth but low margins, or high margins but low growth. Microsoft offers the best of both worlds. The premium is the price of admission for this level of quality. Our final verdict: Microsoft is the king of AI. We rate this stock as overweight by, in a world of AI speculation, Microsoft is the reality. Expect volatility as they ramp up spending, but the long-term trajectory is undeniable. This is a long-term compounder that belongs in the core of any growth portfolio. Thanks for watching StockScope.